Hi, everyone. Welcome to the TimingResearch.com crowd forecast news for June 12th, 2023. We are recording this at 1 p.m. Eastern Time, and this is episode number 389. Today, we're going to have a special Option Professor solo market update episode titled Short-Term Trading, Limited Risk Using RSI Divergence. So I'm going to go ahead and turn it over to the Option Professor.
Okay, thanks a lot, David, and thanks everybody for being here today. Hopefully as many people as possible could get here. We are going to go over all the different markets. We're going to go over my views on what's going on in these markets. We're also going to go over how we're using this divergence with RSI to be somewhat effective on finding some market turns and some opportunities. I'll get into all that, of course. And then if you have questions, there's a chat box there. So we'll try to get to your questions as well. If you have any specific stocks that you're in that you'd like some opinion on, obviously put it in there and we'll take a look. Just before we get started, I'm going to be going over my opinions, my observations, and we're going to discuss my opinions and views on certain technical indicators and option ideas and things like that. And of course, we always recommend that you consult your brokerage firm to go over your suitability and your risk tolerance. That is not what we do. And we don't give out advice. The advice comes from obviously your brokerage firm or yourself. And again, we wouldn't know what's suitable or what's not suitable for you. So again, we're just sharing our opinions and our views. Background here, I've been doing this for decades. I've done hundreds and hundreds of option seminars throughout the country and Canada. And we have educated thousands of investors over the years. I'm very obviously familiar with the options for decades as well. And I'm very familiar with all the markets because, again, I've been into this thing for decades. So I'm going to give you a straight talk as far as I can see. And let's get started. And I'll help you with that right now. Let's talk about the S&P 500 as a broad-based index. You know, for the year, it's up about 12%, but equal weighted, it's only up about 2.6%. So right off the bat, what do we know? The same thing you've been hearing in the news. It's been a pretty narrow rally this year. Now, last couple of weeks, it did expand a little bit with the industrials kicking it in and also the small caps. Now, you know, the small caps have been beaten up. If you look from last October to now, you know, their rally compared to what the other ones have done is very, very lagging. And also, they've done a reshuffling this month of the index, the Russell 2000. So that creates a lot of internal buying power because the funds, mutual funds and ETFs that deal in this stuff, they've got to make changes. And so, you know, you're getting a good little pop. You know, once it got above 175, we got a pretty much constructive thing on it. We thought it would have a problem at 190. We'll get into the Russell in a second. But again, the big broad strokes are what? As far as I can see, this is a very, very critical time around this 4350 number. Why? Because it's about a 61% throwback from the 4800 and the 3500 low and high that we've seen. So you're into a little bit of a Fibonacci turn back. You also have got sentiment, although people are saying they're negative and negative and negative. You know, let's be frank here. I mean, these stocks have gone up for a reason, and somebody must be buying them. So again, now there's been a new call that the bear market is dead because we've had a 20% jump from last October's lows, which is by definition supposed to be the end of the bear market. Okay, so you got that going for you too. You also got the VIX. The VIX went down to a 13 handle. And obviously that's very complacent and very bullish feeling out there. So while everyone might be saying they're bearish, the VIX is certainly not telling you you're bearish at all. In fact, it's telling you you're about as bullish as you've been in 3 years. So the sentiment indicator is, you know, obviously on the very high end of bullish. It is got the throwback rally going on. And you've got the big week here of a lot of optimism because we're expecting a CPI number that's very weak. And we're expecting the Fed to skip, pause, or whatever you do when you stop doing something, skip, pause, whatever. And so there's a lot of optimism coming into the week, a lot of enthusiasm, and the VIX was low. Now, today, it's interesting that the market has rallied, but the VIX has jumped up. In fact, it gapped up today, and it's in the 14s now. So I don't know what that means, but generally, the VIX doesn't pop like that if the market rallies. So that's something that caught my attention a little bit there. The Fed statement is going to be big. That's going to be on Wednesday. And so basically, you know, if they come out and say, listen, we're taking a skip or pause here, but let's get it frank here. The core CPI is still 4 or 5%. And, the last time we had this type of inflation, we had to keep the Fed funds above the inflation rate, and we had to keep it there for a while. And the Fed funds got a lot more than a 0.5% over the Fed, over the core rate. So again, we'll have to see, because there's a lot of people who are, again, calling for rates to drop, Fed to cut by the end of the year, and this and that. And there's some people who are also calling for a recession by the fourth quarter. So again, we're in the third quarter, right? So we're going to be in the third quarter shortly. And then we're going to get second quarter earnings. Are the second quarter earnings going to be as robust as Q1? Q1, we were expecting 8% drop in earnings. We only got 3%. Get the party hats out, right? Except that it was 3% lower than it was year over year. The big thing with the VIX, there's a couple of things that people are using as statistics. We'll have to see how accurate they are. But if they're accurate, this thing's going to go through the roof. So here's the deal. After you get a 20% jump off the low, some are saying that the next 12 months can give you returns up to 28% or averaging 28%. That's a big number. Also, when the VIX has a year over year decline, there are those who believe that we get a 22% median jump. So the VIX coming now, I always believe that. In other words, the reason big money has come in from October to now is because the VIX is moderated. There's big commitments are hard to make when the markets are collapsing. I mean, let's be frank, right? So again, by the VIX going into this very, very declining thing since last year, that has attracted money back into the market. Money that would never have come in if the VIX didn't come down like it is now. So there's no question the lower VIX has been a cause for the rally, no doubt about it. Because again, there's a calmness to the prices. We're not getting, huge drops like we got last year. So that's comforting to people. And again, people are out of the market. So, the salesmen and the financial planners and all the fiduciaries, right, are out there telling people to get back in, and they're coming back in. So again, right now, we got that S&P right up towards that high point that we've had around 43.25. Obviously, it looks like it's going to try to take it out. And this week, again, if we break well on CPI, core, and the Fed skip and the Fed statement, obviously there's enough optimism here to cause a pretty big spike up. But we'll have to see. So again, that's the kind of the picture going on. There is some deflationary forces out there. China is very much got lousy economic numbers coming out on their import exports. They are increasing their money supply. And talking about money supply, ours was up 26%, I think, in 21 or 22. And then they've dropped it from 26% jump in money supply, M2, all the way down to minus 5%, which is the lowest since the Great Depression. So again, that to me is not a positive. And I don't know if this is a situation where the lag effects will start really kicking in the second half of the year. That's what some people are saying. That's where you get that recession talk by Q4. How does that happen? It would happen with what? Earnings starting to dry up in Q2, definitely drying up in Q3 during the summer. Okay. And starting to really see some lag effects kick in. And again, the energy prices are telling you something's going on because, they went up towards 83, where we talked about it being resistance and coming back down. It went back down to test support around 64, 66, just had a bounce into the mid 70s. And now we're so underwater again. So the bottom line, and they're cutting production, and we're underwater again. So there is some definite vibe out there. They say Ireland and Germany are kind of in a recession. Our manufacturing is in a recession. The only thing holding us up is the consumer, who, you need a silver bullet to have them to stop spending. They got credit cards out there and all kinds of stuff to keep the thing going. They do like to spend money, particularly right now on travel and fun. So fun is in. That's why you're getting, things like the cruise lines and the casinos have done well and all that stuff. But, sometimes fun runs out, and we'll have to see if this summer you see some pulling back on this stuff. But, with the stock market up and unemployment at 3.7 and their wages still rising, you still got people out there who could spend money. So you got to be careful about that. Anyway, let's go into these markets now. because there is a lot going on, and I'll share the opinions we have. Okay. Stock market. I look at things on a 20-year basis, 5-year basis, 1-year basis, and 1-month basis. So that gives me big picture, middle picture, shorter term picture, and very short term picture with the 1 month. Okay. And if you're doing short term trading, I'm going to be talking about the 1 month because, again, when you're doing short term trading, you might want to know what the big picture is. That's not a bad thing to know where the highway, where the I-95 or the I-405 is going, right? Those are big freeways on each coast, right? And then basically try to work within the main highway. So let's talk about here right now. What is this telling me? It's obviously telling me that the trend is up on this, and you can tell right now that as long as we cannot get underneath 4,000 on the S&P, and we'd certainly have to break under 4,200 for anything to really start talking negative at all. So, if you're a long-term holder or, you're concerned about the values, there's a reason why these values are going good, because ever since when? March of this year, when it popped above the red line, which is the shorter term average, and now the red line is pointing up. So that's all very positive, very positive. And again, it's popped above the green, which is positive. So if you ever get under 4,200, if you ever get under 4,000, that would open the door for a recession and the big drop, maybe like we saw down here in 2020. I mean, look at this moving average. Tell me this wasn't a great one to be using. Right there on the number, bam. Rather than everybody selling out, if you had this moving average, you would have been buying against that. Well, again, it is an attractor. So if you see earnings like Druckenmiller's talking about dropping 20 or 30% by the end of the year, again, you could go out and test this stuff. And that's where I'm still thinking you should have some powder dry in case we get a 3,200 reading and a bad situation by Q4. Keep some powder dry. But again, right now, this thing is, you don't fight the tape. This thing is strong right now. No doubt about it. Okay. And the RSI is above 50. So that's positive too. Okay. But there's your warning signals, right? There's your warning signals. All right. You go over to the 5-year. And let's see what you've got here now. You've got 4,200 again, big numbers. So as long as we're above 4,200, and look at all that support that should be at 4,200, because these are high points that should be coming support on the way down. So you got a pretty good line in the sand there right there at 4,200. And then, of course, you got rising averages, which is not bad, And again, they all seem to have crossed. So that's good too. So again, this is not a time to be negative on it from the standpoint of the trend. The trend is definitely looking very nice. Let's look at RSI and if there's any divergence to show you. And there's not. You see this high is 58 and you see that high is 63. So there's nothing to show you divergence wise. So there's no signal that way. Let's go to the 1 year. Okay, now let's see if there's anything going on. Right now, you got 4250 with the red line. And so basically, let's see if there's anything that tells me anything here. First high point here was 58. Second high point up here is 65. Next, we're up here at 66. And next to it is 66. So the bottom line is there's no divergence, but you're also not seeing the RSI scream. But again, I'll tell you something about RSI, and this is why you have to be careful about a spike up from here if this week turns out optimistic the way the vibe is entering the week. In other words, we're entering the week with a lot of optimism on the CPI. If that delivers, is it buy the rumor, sell the fact? Maybe not. Maybe it's buy the rumor and buy more. And then as far as the Fed, they do a skip and they say, yeah, we're still looking at it, but it does look like things are going our way. And it's a very more dovish thing. That could be enough to get this thing going. Because when RSI gets above 60, you see, it was, last time it was up here, we were at, we went to 54, right? Once it breaks above 60, like it did here, which is basically in June, that's sometimes when it accelerates and goes way into the 70s. So again, there seems to be a little bit of a gap over here between the low there, which is 43.72, and the high there, which is 43.61. So, if I was a guessing man, if things go well, that would be a gap that might get filled. So you could very much go into the 43.75 area if things break well this week. And maybe at that point, it might be a thing where all the shorts have been blown out, sideline money has come in, and then maybe if the Fed gives a statement of more, or if people start thinking a little bit more about, hey, Fed tightening or something, that could be a neighborhood where it could hit a short-term peak. So look out for that number. I don't think people really recognize that, and gaps tend to get filled. So keep an eye on that. Again, I don't see any big divergence to get jumping out of your seat. Now, again, you like to see the RSI making a higher high when it goes up. And, since these numbers here are just about at 65 and right now we're at 66, that's not great, but it's not terrible either. On the 1 month, let's see if there's anything there that tells us, okay, here you got a high point here, what, 72. 72. And over here, you got a high point of 67. Now you're starting to talk a little bit of divergence. And now you got 60. Okay. This is what you look for when you're trying to think it might make a turn. Okay. Watch it again. 72, right? Over here, 62. Over here, 60. So what are we talking? We're talking about a little bit of a, and by the way, let's talk about what this RSI divergence I'm talking about means. Listen, RSI, and I'm not an expert as far as, how do you figure out the RSI? What's the mathematics involved? I just use it kind of like I use my speedometer on the car. I know what 60 means, but don't tell me how they got there, So I know what these numbers mean as far as my opinion is concerned. And with RSI, if you're above 50, you're in a generally positive environment. If you're under 50, you're in a generally negative environment. If you break above 60, you can accelerate to the upside. If you break under 40, you can accelerate to the downside. That's how I feel. Okay, so this is telling me on a short-term basis, okay, this could be giving us some signal of a turnover. Now let's look at the 5-day. Again, high point here was 66, high point here is 56, okay? So here would be a point that I would be entertaining a weekly option on the put side, okay? And basically, you can do it any way you want, okay? I'm talking opinion here. I'd probably go with a little bit in the money. Okay, well, or a little bit out of the money, very close to the money, none of this deep out of the money stuff, because you might not get a big drop. I mean, let's put it this way. You see right here, let's get it here, 67 and then 66. Let's just say you took a shot at it here. You may only get a 15 or 20 point drop. Well, if you're in a weekly option, okay, you could get some action on those puts because they probably have very little time premium on them, right? But if you don't cover them or keep an eye on them and then they go back up, you lose your money. So again, with options here, you have to, this is a suitability thing off the bat, right? You got to talk to the broker to make sure you've got the risk tolerance and you've got the risk capital and you've got the suitability for it, because this is gambling at its best level as far as, this is the highest area of gambling, because why? You've got a very short time. You got to be right away. And if you're wrong, you're going to lose all your money. That sounds like the trifecta of risk, right? But people do have risk money. Look at the volume on these things. People are buying and selling them all the time. So I'm just talking about if you have the risk capital, if you're suitable, and if your advisor has said it's a good idea for you, then this would be the way I would look at it. Okay, so again, that's what I'm looking at here right now, is a little bit of an opportunity that might be happening if we can get underneath, particularly if we get underneath 43.15. Okay, so again, this would be an area where you go a little bit in the money, a little bit out of the money, and if you go short term on the options, again, this is a big week for news, so it's probably going to be a feast or famine deal, because if these numbers don't come in as expected, there's obviously a lot of people that could come out of the market. If they do, anybody who is short, they're going to get blown out, and sideline money who's been hearing from their advisor, get in, they'll probably capitulate as well. So this is going to be a pretty wild week, I think, for volatility. That's why the VIX has popped up here, right? I mean, we have a rising market and a VIX rising. That's a little weird. All right. So anyway, that's the story here on the S&P. A little bit of a divergence here on the short-term stuff, not so much on the long-term stuff. And again, you got to, when you do this type of activity, short-term trading with limited risk options on the buy side, you have got to watch them because again, you have to be quick with the trigger to cut and run or to grab the money when you can and call it a day. A lot of people like to trade for a certain hour or certain, well, you know, guys who like to do that kind of stuff. You know, if you get an option here for a buck or so, and it jumps up to 180, you know, that's an 80% jump in that option. You know, you could take the money and run at that point. And even though, you know, you might make more by holding on, you could also grab the money and run as well. Again, if these things go against you, these options will go to zero very fast and you will lose the entire premium. So you have to understand that right off the get-go. Okay, well, that's the story on the S&P. And now let's take a look at the story on the Qs. And then I'll get into a couple of different stocks as well. Okay, let's go. I start out with the big screen. The big screen is the 20-year graph. Okay, obviously this thing turned up here at 300 again. And so that's where you should have really been getting in there and not as extended like this. Let's see what the RSI is doing. You got a high up there at 58, and then you got another one there at 60. So it's making a little bit of a new high, and RSI is kind of around the same. Nothing really to show there. Again, you need to get back under 320 to turn this thing south, and then under 300. And then it would open the door for here if we have that big recession thing. Okay. That's when you're going to test something like that. If you had a big recession thing and then everybody changes their tune. Well, you know, didn't they change their tune on EVs and in Bitcoin? Didn't it go from we're never going to use the dollar again and digital currency is the only way to go? And didn't we go from everyone's going to go electric to much longer term on electric? And there's a lot of flaws in this digital stuff, right? So right now, the whole world's saying AI, AI, AI. And what if the language changes more to, yeah, it's great, but the economy's slowing, so we don't need AI. As you know, we don't have the money for AI, or we're not going to jump on AI as fast because, you know, if we don't have any business coming in, it doesn't matter how sophisticated our AI systems are, right? So we can delay that. And this market is not priced for delay in some of these AI stocks, right? So that's how the news can change. And that's why you have to be always open to change. Anyway, let's take a look at number 5, the 5-year. Okay, here you got a rally to 72, and then you got at 72, so no big change there. And now you're at 73. So this thing's been kind of making new highs here, but it really is not going much higher on the RSI. Not something to that jumps out to me, but something to keep an eye on. What about on your 1 year? You got the RSI at 75, then you got the RSI at 75, no change, and now you're trading at 71. So it again, it's losing a little bit of steam, 75 to 71, but not tremendous. Clearly, if it breaks underneath this point, that would be a turnaround. But again, you know, like I say, it is a little bit showing, you know, a little bit slowing on the momentum. Okay, let's talk about the 1 month here. Here you got a high point of 72. You come over here, you see 66. That's why you got the dump. But again, this is why you got to watch these things like a hawk, because once you got the dump, it came right back up again. But listen, if you see a divergence there and you take a short-term put and you get a drop from 356 down to 348. And when it was up here at 356, 357, you did a 358 put. I would imagine on a very short-term put, when it drops 10 points, you probably get some action on that. Okay, right now we jump back up to what, 54, and now we're over here at 60. And so there's no help here. There's no help there. So on a short-term basis, there's nothing screaming about divergence. You had a little bit one happen here, which was last week, right? And then now you're not getting that. On a 5-day, let's see what we got. You got a high point here, 71. Where are you over here? 65. So here you're getting a little bit of a divergence. Okay, on the short, this is short term, right? A little bit of a divergence. And again, you know, I don't know what, I don't have the premiums in front of me. You guys could probably look at them for yourself. But a little bit in the money would be 358, a little bit out of the money would be 357, short-term option. And then if you're going to get a little bit of a drop, you might be able to get some action on that. Of course, if it goes to 359, you're going to lose the premium and all the money's gone. So, you know, remember that. Okay, let's take a look at the Russell. And we're at the highs of the year on this stuff. So, you can't be too shocked that most of the numbers are going to be somewhat positive, right? Okay. Let me show you something here, though. This is why I use this for all kinds of stuff. Yeah, check this out. You see the high point here is 72. You see this Fugazi high up here is only 62. When you get a divergence like that on a monthly graph that goes back 20 years, you're going to get probably a pretty good drop. And so that's why I was very negative on the market up there. Okay. That's a good signal. That's a good signal. Let's see what the signals look like now. You got a low point here of 46, and you got another low point here of 44, and you got a low point here of 49. So it has picked up a little steam, right? And when you go from 44 to 49, you're getting a pop, and the pop has come in. You're still a little bit under resistance here, though. And let's see if there's any other running out of steam signals here. First of all, you're running into the purple line here, so I would view this as a very important number. What number is that? Keep an eye on 186. You get closing above 186, I think you're in pretty good shape. If you can't do that, that's called resistance, and that could be a problem. All right, so be careful of 186. Divergence here, you got a high point there coming in at 55. And see, this is another thing that I was talking about. Your RSI is around 55 here. If this RSI goes above 60, then you're going to blow through 190 and you're going to go on a run. Okay. But if it can't, this is a number. 60 is a number where it could stop. Ballpark figure. And 40 on the downside. You notice this thing didn't break under 40. If it broke under 40, what did I tell you? It can accelerate to the downside. It didn't do that because it never really broke under 40. See? All right, let's talk about the 1 year. What is this thing? A down flag up pole? Let's see. Okay, you got a high there of 65, and then you got 65, and then you got it down to 62. So nothing really too much to report. Again, the further away you get from moving averages, the more likely they're going to come down. So you see when you're way up here at 200 and the averages are down here at 182, you're going to have a correction. If you're way down here and the averages are up here at 180, you're going to revert to the mean. That's why I use these things. Again, we're way up here, right over here. You're going to revert to the mean. We're way down here. You're going to revert to the mean. Yeah. All right, so let's talk about the 1 month on the Russell, see if there's a divergence there. You got a high point of 70, you got a new high of 71. You got another test up here down to 64. So you lost a lot of altitude on RSI, so that was like a little temporary sell, but you didn't get much out of it. But again, if you're dealing in short-term options, a 5-point drop or something like that can be effective because again, the time premium on extremely short-term options should be very minimal and they are going to react a little bit because you're close to the money, right? That's why you want to be close to the money, in my view. Again, these are all my opinions. A little bit in, a little bit out. The reason you don't want to do at the money is that's all premium, and you kind of don't want to really pay all premium for your option. That was the old school that I was taught. Okay, so that's the story on the Russell right now, 59, 63. Again, a little bit of a divergence here to have it go up. But, I would say if the Russell looks like, it could go back on the bicycle above 188 and it could be going a little bit down. There's a big gap down here. Big gap down there. So if it does start fading for a reason, then it could go down and, that's an attractor. So we'll have to see if in the month of July, it goes down and tries to fill that gap if this bloom comes off the rose. Again, regional banks had a big bounce back. That helped this, okay? And of course, they were very undervalued. If we go back a year, let's just take a look at that. Can you see that, this is the October low of last year, right? October low. Now, this thing from October all the way to May hadn't done anything. So again, this is playing a game of catch up. The question is it just a little short covering bounce because regional banks haven't all gone out of business? And now the reality of the economy might be slowing, credit card defaults might be picking up, commercial real estate might be a problem, comes back in the picture, then it's going to drift back down. But again, you can see this was dead money while everyone was making tons of money in the S&P and in the NASDAQ. This thing between October and May did nothing. So again, it is getting a bounce because of, and here's your gap. You can see as clear as a bell. So we'll see what happens. Is it a down pull, down flag, up pull? We'll have to see. Certainly getting above 87, 88 would tell you that might be going on. So keep an eye on the Russell that way. All right. So you got the Russell. Those are your small caps. You got your tech. Now let's talk about some individual issues and show you where I found some stuff in there. And then I'm going to get into some of the different markets that are moving around. NVIDIA. People are going, why are you negative on NVIDIA at 420? Well, I'll show you why. I'm not, listen, I don't know what's going to happen any more than the next guy. I'm just looking at what I read and I'm acting accordingly. You had an 82 here, right? 82 on that high. And then you make a new high up to 420 and the RSI goes up to 85. And then all of a sudden it drops down to 73 after it was at 72. So you start losing some value. I'll even show you something better on the 1 month. 87. Yeah. You got 87 on the high end, and then you got a brand new big high in enthusiasm, and you're still at only 87. So that gives me an idea that it's running out of steam. Plus I got a gap there, and I got a Lake Michigan gap down here. So I'm just looking for what? A pullback, not collapse. It could, but from here to here on a short-term option is good. Okay. And that's why you take your shot. Why do I call it taking your shot? Because if you're wrong, you're going to lose the premium. Right? That's called taking a shot. All right. So that's what I saw there on that one. Let's see here. 52 there and where? 42. Yeah. And then what? 49. So you got a little bit of a mini deal here. 42. And then you got 49. You could take a shot here. And if you took a shot there at 370, you got your pop. Okay. All right. What else was I looking at? Yeah. Lululemon was a good one. Lulu. One of my son's friends works at Lululemon, and he says it's a pretty good place to see very attractive people. So that's interesting. Anyway, Lululemon before the thing. Here, watch this. You're at 22. Well, hold on. Start here. 20, right? And then you're at 22. And then when you come way down here, you're still only at 20. So the thing's making lower lows. RSI is not making any lows. They got an announcement coming up. Okay, the thing closed at 325, 328. The 325 call was going for $1,500, limited risk, and it had just a very short time on it. So it was you'd have to have the risk tolerance and the risk capital to put up $1,500 and lose it quickly if you were wrong. But in this case, you weren't wrong. They got good earnings and it gapped up. And that option went from, it was 325 and it went as high as 385. So it was in the money by $60. $15 to $60 is not a crime. Now, again, you got to be on your toes, or and anywhere along the way, you could have grabbed out your money. Okay. So that's the other key here, and that's some of the things that I talk to people about when I have sessions with them is how to manage these things. Do you want to roll them up? Do you want to, if you bought a couple of contracts, you want to sell off some? Do you want to spread them? There's a whole bunch of different things you can do after you have a trade on to, shall we say, adjust the risk. First thing is obviously like fishing. You want to get a fish on your hook. And after you get your fish on your hook, then of course you've got to manage it to get it in the net and then on the boat. So there's a few phases to trading, just like fishing. Okay, so that was Lululemon. Now, again, sometimes what I like to do is scan the 52-week high and the 52-week low list. Now, why would I want to do that? Because anything making a 52-week high, I know a couple of things. One is the market has been extremely strong because it's at the 52-week high. We probably have a lot of people who've bought in. And if the market does run out of steam, we probably have a good amount of people who want to come out and grab that money. So we've got some sellers already who are ready to go, just waiting for the sign of weakness. We also have people who like to short the market when it's up. And of course, that's how sometimes we can get something to roll over under its own weight. That's why sometimes like on Lululemon, I mean, what happens with Lululemon here? Obviously, there's a market maker, and then there's the public and the institution people. Well, if institution and the public all are buying and there are no sellers, who's on the sell side? The guys who make the market makers, right? Doesn't Citadel make a market, right? So they probably are going to raise the offer price to as high as they want until these people get done. And once they're done, they obviously are making an assumption there's no volume behind them. So obviously, if I can fill all these people at 360, 380, and 385, and the volume drives up, right? Then what? Then it'll fall under its own weight. And that means they're short at 380, 385. And when it comes back to 355, they can cover and make their money. And they have filled all these orders. Okay. So that's why you have to be thinking like almost a market maker, in that when everyone is doing one thing, somebody's fading it, right? So that's why you look for something that might tell you that it's running out of steam. Either way, up or down. And you can see here, we went to 49 on RSI there, and then we went down to 48. So you made new lows, but RSI basically the same. So if you want to take your shot, and then look, it jumps to 53. So now you got a turn in RSI. I mean, right here, the RSI was at 48, 49, and then you're right over here, it's at 53. So that's why you get the pop. Okay. What else is going on? So that was the Lululemon example. How about stocks like Apple? I mean, Apple, their growth of revenue and everything like that has not been that tremendous. And the stock's going up like it's, out of this world. Right here, you're at 77 on RSI. The next bar over is 68. That's why you hit it. Yeah, people are wondering why, Jim, what are you negative on on Apple last week? It hit 185. It's an all-time high. It's almost going to be a $3 trillion company. Are you out of your mind? I go, maybe I am out of my mind, but I just saw a divergence here and I'm going to take a shot. And that shot took you from 185 down to 177. And on a short-term option at 186 or 184, you probably got some pretty good action on that. Okay. So that's a good example of that. How about down here? 46, 53, boom. Okay. So that's why I like to use it. And again, now, that's giving you the broad strokes of, how you identify it. The next thing is, how do you pick the strike price? How far out are you going to go? And after you get it in there, how are you going to trade out of it, right? And these are all things. I'm not going to be able to go over all that here today. I'm trying to show you basically where I get some of these signals from and stuff like that. Okay, so another one I was looking at was some of these ones that are 52-week lows. Estee Lauder, okay? Estee Lauder, it's right there on the line, right? This thing used to be 380. People don't like makeup anymore. Not where I look around. Everywhere I look around, women seem to be looking with the makeup, huh? So you got makeup discounted down quite a bit, right? So is there a possible deal down here? Well, I'm looking. And you got the low of 37 on RSI, and then you got the low again of 37. So you got the RSI pretty flat, even though it made a drop. And if I go to the 5-year graph, again, there's 30 against what number next to it? 28. So there's no real divergence there. So, but it does look like it's ripe for possible. So that's why I'm monitoring it very closely. Here on the daily, you've got 29 on that, and then you got 29. So it's kind of flattening out, right? And a reversion to the mean occurs. So this would be something I'd keep an eye on, because I don't think makeup's going out of business, and this thing is definitely discounted. Now, I don't know the whole story about it, so you might want to read up and find out if there's any malfeasance going on here or any other crazy story that could come up in this day and age, or any day and age, right? So that's one right there that I thought looked kind of interesting on a 1-month graph here. You got 29 again against 39. So that's where I got a little bit of excitement here today. 29 there. And then we went down here and you got 39. So that's where you take your shot, and you got a little bit of a pop going on, but it's not really following through because the red line is a problem. Okay. Next one, Dollar General. God, even the poor people can't do much. The bargain hunters, because this stuff is all about bargain hunting. You go to a 20-year graph, you can see this thing used to be 260. It's at 152. This thing was a darling. Come on, does that look like a bad stock? Thing was minting money, and you use the purple line, boom, boom, boom. Once that purple line got taken out, though, it was sayonara. But now it's way down, away from the averages. Reversion to the mean is something that could happen. So you got to keep an eye on it, because I don't think it's a terrible company. Big gap there too. That's a Lake Michigan, right? Right there, boom. So where's the RSI? 14. What's the one next to it? 14. So it's, if we start making any kind of new low and the RSI is at 20 or something, that could be your tip. But this is one I'd keep an eye on because I don't think it's a terrible company but I'm not an expert in it. On the 1 month again, 22, 20, 23. So you're picking up on RSI a little bit. And now you're still at 23. So if this thing could start popping above 155, that could be an indication of a turn there. You keep an eye on that one. But again, this is coming off of the all-time lows. Another makeup deal is Ulta. I don't know. I guess it's retail sales and this stuff. Plus, these things went through the roof for so many years. Ulta Beauty. Look at that. I mean, come on. But look where it is. Same thing so this might be time to take a shot at the old foundation and eyeshadow business, huh? And take a look here because, every time it hit the line in the past, it wasn't a bad time. So, and like I say, people like makeup, right? So there you go. There's two of them. And the same idea here. Let's see what the RSI is doing for us here. You had RSI here at 34. Look at that big new low to 400 and the RSI is 35. So that's kind of a signal. So, and now it's above the line. Line comes in at 411. So we can stay above 411. That'd be real positive for that stock. And there you go with 18 followed by 28. So there you go. That's where you got your best signal here. You see on the 1 year, you're down there at 18. And then the next one down there is what? 17. So you got a flat with a new low. And then boom, you went right to 28. So when you jump right to 28, you're going to get a pop, and you did. Now we'll have to see. It's, these things are having trouble with their down moving averages. But, these are ones to keep an eye on because when things are pressing these kind of levels against their numbers, like this one is here and SD Lauder, this is the time to find it interesting. You're not going to find a line wrapped around the block telling you to buy right down here at 340, right? They're going to give you around the block up at 560, and you see how that works out. So you got to keep an eye on these things. Like Jimmy Butler said, we can't get too low or too high. We just got to keep going. Well, the Heat looks like they're going to be going on vacation, maybe. Who knows, right? All right. Let's see. We're at 44. I think I've given you enough examples of what I'm talking about using this stuff. And that's what I try to help people with this thing. So I'm going to, before we run out of time, I'd like to go around the loop here and show you some of the other markets and where my opinion has been on these things and see what you think. I already showed you my opinion on the S&P. Let me show you my opinion on crude oil. Because I think we've been pretty good with people on this. Our opinion has been pretty good. So I'll show you why. All right, we go to the 20-year graph here, right? And you can see this is why we've been buying against the 66, 64, 65 area, because the purple line, and we did get a nice pop, but you see it can't get above the red line, and the red line's pointing down. So when we got on the first time it went down there to 64, we said, that's a good time. And when it went up here towards the red line at 83, that's the time to dump. And then you stay on the sideline, because that red line pointing down is ominous. And ominous, like at some point, if they break here, you don't know what's going to happen. Oil does crazy things. If you don't think it does crazy things, look at it. It can do crazy things. This was negative $40 a barrel, negative $40. Obviously, this was one of the best opportunities of my career. Oxy bonds, non-callable, 2029. We're going for 35% yield. I mean, you put $1 million in there, you got 350 grand coming in from Oxy Petroleum, guaranteed because it's non-callable, guaranteed by Oxy. And that's pretty darn good income for 10 years. And obviously Oxy can certainly pay their bills now because it's back up. And of course, Buffett is a big holder. So that was one of the best things I've ever seen in my career. That and 16% treasuries back in 80 something, right? Anyway, again, reversion to the mean. When we're way up here, okay, it's going to be coming back down. Why? Because it's overbought, and at some point the supply will come in. Like I say, this thing is very much in a tight box here. That's why I've been saying, you get above 83, it opens the door for 100 or better. You get under 65 or 60, it's going to go wherever it wants to go. All right. But right here, you're kind of holding on for dear life, and that's not a place to be. So really, I'd rather buy it at 83 on its way to 100 than to buy it here at 60 or 70 and sweat bullets all night. That's my feeling. All right. Let's talk about, well, let's show an oil stock for you. How about Exxon? Okay, Exxon hits a high point up here at 71, and then the next high is 66. That's why we're dumping at 120. That's why we want no part of it, right? And again, you got the signal, and you know you're this far away from the moving averages, and we know they gravitate back towards the averages. So that's the story. All right, let's look at gold. Gold. Let's put the August gold up there. All right. So the gold August, well, let's see if they give me the front month. Okay. Now here's why I was negative on gold. First of all, I was positive on gold when it got above 1800. You can see that. That's your buy. But why did I fade it going into the 2075 number? Here's why. You see the first high point here of 2020? RSI's at 83. See the next high over here? RSI is 60. Remember, it has to get through 60 to accelerate to 70, and then you'll be at 2300 gold maybe. Next time up here, it goes to 58. You see, if it can't get above 60 on the RSI, then you're not going to blow through this number in my view. But you got to like the fact that this thing is looking like it's an uptrending thing. So if it does pull back and hold, that would be interesting. And then if they, I mean, this fiat currencies, unbelievable, right? How much they print and stuff. So obviously there's good reasons why people want to have a little hard money. Unfortunately, hard money might not do good if they keep rates high, the deflation starts hitting and the recession starts hitting, and the dollar picks up steam. That could be the trifecta to send gold down to $1,500 an ounce, which no one is expecting, right? But I don't expect or not expect anything. I try to read the tea leaves and then I go with the flow. Right now, the flow is pullback and consolidation. Now, getting under 1950, I think would be interesting if you want to be bearish. You see, it's curling over here and it comes in at 1981. You notice it hasn't been above 1981. So if we got above 1981, then I'd answer my telephone if a bull was on the phone above 1981. Okay. And it is holding the green, which comes in at 1935. So if we close under 1935, that would be a signal that it's starting to lose its altitude. And here another one. You got RSI at 69, makes a new high, RSI 67. That's your running out of steam, and that's how you get the drop. I'm not saying it's going way down because there's no evidence of that right now. But I'm saying that if it broke under 1935 and 1850 and 1800, it's going to open the door for that long-term average. Likewise, if it breaks above 1981 and then 2000, well, where else? 1981 comes in again, 1989, starts breaking above there. It opens up the door for up here. But that door is not going to be open if it doesn't hold. And look at this. It's been tugging onto the 1940. So can you see, I say if it breaks under 1935, it's going to be maybe sayonara. And again, it's got to get above this resistance, which right now it doesn't look like it can do. But if it does, I'm not going to argue with it. I'd go with it. But again, the bandwagon on gold pretty heavy because it's gone from 1800 up to 2100, and every ad on TV is about what, buy gold, you need gold, and every salesman. And these coins, I mean, they mark up these coins tremendously. When I hear, $20, $30 over spot, or $3 over spot in silver, that's not telling me we're at the bottom, because those premiums are huge. And, those premiums can come back down, and that's a problem. It's like a PE ratio a little bit, PE ratio, you buy in at 30 PE ratio and they bring it down to 15 or 20 PE ratio. Even if the company's making money, you're going to lose money because they contracted the valuation, right? All right, so there's your gold, and there you got your oil, and then there's some industrial metals that I thought were interesting. So let's take a look. This is the ETF on it. And you can see there's a gap down there. I don't know if it's going to come back down and get filled. It's definitely on the defensive. It was having a pretty good time of it last year going into this year. But again, this is telling you recession. When industrial metals are downtrending, it's because of a slowdown coming, not a pickup, right? But there are some that look, let me put it this way, if they are going to have infrastructure as a way of getting out of it on a longer term basis, some of these things look pretty interesting to me. Alcoa aluminum is interesting because it's very discounted now. You see, I mean, it used to be $60. It's down here. So obviously it's interesting, but you got a gap there. But let's just see if there's anything going on with Alcoa. Again, it's still good. It's underneath the purple here. So for all we know, it's going down here. But if it does start moving above what number? Above 36 and change, that would be a positive. And then, of course, above 41 would be positive. So keep an eye on that because this thing could go. I mean, obviously, look, just last year was up at 100. So very volatile, aluminum, very, very volatile. But keep an eye on it because, again, if there is an infrastructure deal, this could be a neighborhood of interest, right? So there you got your numbers there. Any divergence here? Let's see. You got 45 there and you got 45 there. So nothing really big, but it's certainly not making new lows. That's not bad. Now, I'll tell you something right here. You see this high point 78 and look at that huge high at 82 followed right by 63. So, if you go from 83 down to 63, that thing ran out of steam. And did it run out of, and how far it away from the averages? So, you might be onto something. Okay, let's take a look at Cleveland Cliffs. Again, this thing starts getting back above 17, 18, 19, 20. It could maybe get going someplace because historically it has been able to go pretty crazy. So I'm keeping an eye on this one as well. Yeah, you see here, you got a low of 44 and then you jumped up to 48. So there's some constructiveness there. And of course you got US Steel. I know a lot of people like Nucor too, NUE, but I'm just giving you a couple ones because these are cheaper, $22, pretty cheap. And this thing's hanging in there too, right around there. So again, if this thing got going and there was an infrastructure deal, and for whatever reason, there was a supply of this stuff, these are all commodities, right? So they have supply and demand dynamics. The one that I've liked over the years was Freeport McMoran. Or McMoran, whatever. Okay, let me explain why I really liked it when it was down here, because you had RSI at 41 and then you had it drop all the way down here and the RSI was 42. Now, when it got down here, the reason I liked it was when I buy anything under 10 bucks, I view it as a long-term option that will never expire. Why? Because, it's a $5 stock. It's an $8 stock. That's what you pay for an option, right? But this one isn't an option. It's actually shares. So unless they go broke, and are we going to go out of the copper demand business? I don't think so. So that's where I threw it in the IRA. And that has been a very good thing. Now, when it goes way away from the averages and I get some kind of a divergence, look at this, 69. And then we got what, 59, I'm dumping. And then when it comes back against the averages here, and I got another divergence of 47 and 50, then I take another shot. Now it comes back down here, you take another shot. And if it starts closing underneath what? About 34, then I would change my tune on it. You want this red line under the price if you think you're making any money. So the bottom line is right now it's under the price, so that's good. So, these are some of the things that I do to keep an eye on things. And what I'd like to do now, if I could, is invite you guys to get a hold of me. And what I can do for you here is I've got some PDF reports on option trading and PDF reports that can help you with hedging, how to hedge, and some of the mechanical stuff on, rolling positions. I also have a list of the best stocks by sector. So if you started seeing AI and then you see the sector that I've created for AI, you'll notice all those stocks, pretty much have really benefited from this jump. So it's very nice to have a nice reference, guys. So if industrials look good, you got the industrial stocks there. If the healthcare stocks look good, you got some healthcare, you got it all broken down by sector. I thought it was helpful. Anyway, so you get those three things there. And then, I don't work with this, monthly charges and annual charges and blah, 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 blah. I work at a flat and hourly rate. And the rate what I'm offering here at the meeting here is 50% off the rate. So it comes in at 99 bucks. So for 99 bucks, we can have our initial stuff where I can further explain how I approach these things and my views and my opinions. I could educate you and share my opinions with you. Again, I don't recommend what you do because, again, you go to your financial advisor and your brokerage firm to go over suitability and risk tolerance and risk capital and all that stuff. And then they work with you to find out what's right or what's not. But I have opinions, and I do share them, what my opinions are and how in my opinion, is the way to approach some of these trading things. And there's a lot of different ways to go once you identify these things. You can go with long-term options. You can go with short-term options. You can go within the money, out of the money. There's a lot of ways to go. And during our 1 hour session, we try to cover those. And obviously, I always encourage people to write down questions so we can hit all the stuff you want. And then if you want to have ongoing sessions, obviously, we can do that as well. Because obviously, if you find value there, you come back for more. So I think that's better than, signing up for this, that, and the other, and, promising these kind of things and those kind of things. All I can promise you is I'll share you my thoughts and my opinions. And again, I've been doing this for decades. So hopefully I can add value. That's the whole idea. So again, you go to optionprofessor.com, OPTION, professor, PROFESSOR.com. And you put your information in, and then I check back with you. Or you can call right down here to the office at 702-873-8038. Again, 702-873-8038. I'm Jim, the Option Professor, and obviously I'd like to hear from you, and hopefully I can help you become more educated, more knowledgeable, and maybe give you some things that could help you in your research. And again, that's the whole idea, is to try to share ideas with you. I see some questions in chat, so let me see if I can get to some of them. Are these the tools you're using on the website free? No, these are not tools I'm using on the website free. These are tools that I'm using in addition to obviously other things. And again, I can share that with you. If you call the office, we can talk more about that. How do you get the PDF? Again, you either call the office 702-873-8038 or put your information in and we'll call you back by going to the website optionprofessor.com. And yeah, those of you who want to know more about strategies of timing, again, call the office and or send your information in, and let's spend an hour together and go through this stuff. And again, if you feel like there's value, you come back for more and we do some more. And if not, you've figured you're okay, then that's it too. So I like that fact that there's not a big commitment here. It's just a 1 hour deal. And then for both of us, we can see if there's any value to us going back and forth with information. And I think that's a better deal for you too. Okay. Well, anyway, I wanted to thank everybody for being here. And again, if there's any markets you wanted me to cover that I couldn't, give me a call and we'll do it. And if there's any questions that I didn't get to, which there should be, let's get together and talk about that and see how we can help you. Okay. This is the Option Professor thanking everybody. Again, remember that the options involve risk. They're not right for everybody. And remember, consult your brokerage firm and your advisor to go over your suitability and your risk tolerance and what risk capital would be appropriate for you, and then make your own decisions. What I talked about here today and all the time is my opinion and my knowledge and my observations, but it is definitely not advice. So we don't give out advice. Okay. All right. Thanks a lot, guys. We'll be with you again, another episode with Timing Research. It's always good to speak to you. And again, thanks for attending. Have a great day and a great week. Let's see how CPI and the Fed comes out. Let's see what things look like by Friday. All right. We'll see you then.